Morning guys, Joel Frank here, market analyst for YouTrading, and in today's video we're just going to be taking a quick look across markets. I'm going to be giving a quick update as to what's been going on this week and how things might play out for the rest of the week. So let's sort of jump straight into it really. Having a look at a couple of charts. There hasn't really been too much going on this week, to be honest. Markets are kind of in wait and see mode at the moment. We've got the release of the Fed meeting minutes from their meeting earlier on this month coming out later on this session. And the main sort of talking point is what Fed members are thinking with regards to the pace of interest rate hikes going ahead. Although I think we have a pretty clear idea of that given recent Fed speak, because we've had plenty of Fed speakers out this week, most of them supporting the idea of slower rate hikes going ahead, and markets very much now expecting a 50 basis point rate hike at the Fed's next meeting in December. Which would be a step down from the 4 consecutive 75 basis point rate hikes that they've done in the previous 4 meetings. But the other main talking point is the terminal interest rate. Now, the Fed, or Powell at least, at the last meeting, he was talking about how the terminal interest rate is likely going to be higher than in the projections from the September meeting. That's what Powell said at the last meeting. There weren't new projections given out. We do have more projections, or the dot plot, as it's generally called, as to where the terminal rate is going to be. New projections coming out in December. But there will be some discussion about this in the minutes of the last meeting, so it will be interesting to see how that goes. But generally, you can see here the dollar's kind of been in a bit of a range. Like, it was a little bit higher earlier this week on those China lockdown concerns, which are still around, but now it's weakening again. We had a bit of an uptick in risk appetite. Let me just show you the S&P 500, which has rallied back towards those recent highs. And the way I'm thinking about markets at the moment, let me just return to the DXY, because I think the DXY could potentially, or the dollar could potentially be one of the key components here. I'm seeing things as we're having a shift towards a more benign macro environment. So clearly inflation in the US has now peaked. Fed hawkishness may have now also peaked. Like, we've got the Fed slowing down the pace of their interest rate hikes. We still don't know quite where the terminal interest rate is going to be, but we're getting towards that terminal interest rate. Like, interest rates at the moment are close to 4%. So, we've only potentially got 1 more percent to go, which is what? A 50 basis point rate hike and then 2 25 basis point rate hikes. The peak of Fed hawkishness looks like it could well be in. We've already had the dollar see a substantial turnaround from the annual highs it posted in September. Like, it's down about 7% from those highs. And I'm thinking that given this shift in US macro conditions, with inflation coming down, the Fed potentially being more dovish going ahead, I'm thinking that we could actually have a break below this 200-day moving average, which, that would have been a crazy thought for most of the year when the DXY kept bouncing at the 50 and 21-day moving averages as the Fed was progressively getting more and more hawkish, as inflation was getting worse and worse and worse. So I'm certainly eyeing some of these support areas to the downside, like around 104. I think a break below recent lows and the 200-day moving average would open the door to a test of that area. Then you've got in the 103s, then you've got around 101. So, the dollar significantly stronger regime could be over for the short term anyway, if things are looking a bit more dovish on the Fed front. I mean, another factor you've got to consider is we haven't had the data out yet. We've got the flash services PMI coming out of the US soon, and markets are expecting that to show that the US economy is kind of stagnating / potentially in a modest recession. So that is a concern for the Fed that also sort of pushes back against the idea of continuing with aggressive rate hikes. Although obviously the US labour market is still very, very strong. So expectations for a US recession at the moment, because of the strong labour market, aren't particularly high, but certainly a slowing in growth. So yeah, it's very much a dollar story, and I think that this dollar weakening could see euro dollar here move above that 200-day moving average. Could see sterling move towards 122 and test that 200-day moving average. And it's all dollar story here, all dollar, because when you look at the the European data and the UK data, well, we had these flash PMIs this morning, and you can see there's a lot of green here because those prints were a little bit better than expected, but still all below 50 on the French services and manufacturing, the German services and manufacturing, the UK services and manufacturing, all below 50, all pointing towards the fact that the Eurozone and the UK economies are in recession. So it's not because people are suddenly thinking that things are going great in Europe as to why these pairs are moving higher. It's purely a dollar story. Um, but anyway, what else has been going on this week? We had a big hefty rate hike from the RBNZ. They've got interest rates the highest in the whole of the G10 now. So, you know, RBNZ seems to still be quite hawkish. And if we do have the dollar weakening and risk appetite and risk assets doing well, like if, for example, you do get a test of this, oh, I can't seem to get it, this downtrend in the S&P 500 and a break above that in the 200-day moving average and a push into like the sort of the 4,200 area, that's going to be good for risky currencies like the Kiwi. So, you know, pretty soon we could be in for a bit of a break above this resistance area in the 0.62 area towards 0.63, which is where the 200-day moving average is, and potentially beyond. But just worth keeping an eye on those things if risk appetite does take a substantial turn for the better. Let's just quickly look at oil though, because oil is sort of moving in this direction that you wouldn't expect it when the dollar's weakening, risk appetite's improving. Normally when the dollar's weakening and risk appetite's improving, you see in oil moving higher. But risk appetite is improving and the dollar's weakening, not as a result of an improvement in global macro conditions. The dollar's been weakening because of all that Fed stuff we were talking about, and the moderation in inflation in the US and the moderation in pace of Fed rate hikes and blah, 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 all that kind of good stuff. And risk appetite is largely improving, well, I mean, as a result of that, in easing fears about excessive tightening from the most important central bank in the world. The data, as we've just spoken about from Europe and from the US, and the situation in China is still pretty bad as well, like with them reintroducing lockdowns and all this kind of stuff. It's all very much still a story of global economic weakness, which is why you're still seeing oil unable to catch a bid, despite, I mean, like we recently had the Saudis pushing back against the idea of increasing oil output. OPEC still seems to be there trying to support this price, but not seemingly succeeding, particularly at the moment. And you've got this oil ban coming up where an oil price cap that the Europeans are going to put on Russian oil. But despite these sort of supply side concerns, you've still got oil struggling. And I'm thinking if we are heading towards recessions, or if Europe is already in a recession, if China growth is still going to be weak, if the US is slowing, maybe not in a recession, but I think that if we are headed anywhere, it's likely towards this resistance area around 62, as opposed to another rally towards 100. That would be where my bet would be, towards 60 as opposed to 100, given we're like roughly around 80. But, you know, we're going to have to see how things play out. In terms of the rest of the week, obviously Fed meeting minutes coming up. And then I think you've got the ECB meeting minutes tomorrow, actually. But aside from these upcoming central bank releases and a few US data points like the flash services PMI, durable goods, unemployment claims, some housing data as well, that's worth keeping an eye on. But after all this, things are going to be dead, guys, because tomorrow is Thanksgiving in the US, and then Friday is pretty much dead as well. So, yeah, I don't think we're going to have any decisive moves in any of these markets by the end of the week. That is going to have to wait for next week. Let's have a look what we got next week, actually. Yeah, well, I mean, actually, of course, it's the US jobs week because it's the first Friday of the month. So we've got ISM data coming out, like there you can see ISM manufacturing next Thursday, US official jobs report, Canadian jobs report, And it looks like we've got stuff like OPEC, Fed Chair Powell also scheduled to speak. That'll be a biggie on the 30th of November. Flash CPI estimates out of Europe. The inflation situation has not been moderating like it has in the US. Also US GDP. Big week next week. Big week. We could see some bigger moves in markets. But yeah, guys, hope you enjoyed the video. Hope you all found it informative. And I will see you all in the next one.